We begin with a trip back to the future for the markets. Let's take a look at this one-year chart of the S&P 500 flagged by our own Dan Nathan. A year ago today, it was trading just under 2,900. Today, basically back to that exact level. So let's fire up that flux capacitor and set the coordinates to 1 year ago today to see what life looked like. And wow, the world has changed. This time last year, the S&P 500 was trading at 17 times forward PE. The 10-year note was yielding around 2.5%. Unemployment was just over 3.5%. And GDP was sitting around 2%. Now, flash forward to today, the S&P 500 is now trading around 20 times forward PE. The 10-year yield, 0.64%. Unemployment is projected to hit 16%, and GDP is negative for the first time in over a decade. The world has been turned upside down, but the market doesn't seem to care. So if you're an investor, should you make like a tree and get out of here? Guy, I'm told that is a funny line from the movie.
You've never seen the movie? I don't think it can last much longer. With that said, I mean, you just have to be extraordinarily impressed by the resiliency. I thought Monday was an extraordinary day, and today, you know, the late sell-off notwithstanding was still very impressive.
Dan Nathan, you flagged this chart for a reason. So what's your thesis?
Yeah, I mean, listen, it's pretty clear to me, and I've been pretty consistent on this. Just first things first, you know, the market has not really made up any ground over the last month or so. It really has been grinding between 28 and 2,900 in the S&P 500. Obviously, the news has been really bad on the economic front. But I'll just tell you this. I mean, like, again, if you're looking at the stock market, the thing that has been most seriously propped up by the Fed action over the last couple months, you're just looking through the wrong lens as it relates to the health crisis and the financial crisis and the economic crisis. And all you had to do was listen to Warren Buffett over the weekend and say he's selling things that he owns. He's not putting that $137 billion to work that he has waiting for a rainy day. So what is he waiting for? He's friends with the smartest guy on the planet, Bill Gates, who's telling him that there's very likely to be another wave of this virus. So to me, I think you wait here. You do not get all in.
Somebody's phone is ringing, guys. Karen, what do you make of the stock market levels here?
No, don't stop. Don't say Guy. It's not me.
Oh, it sounded like an old-timey ring, like your phone or something. But Karen?
Yeah, I'm pretty confused by the action. I mean, you know, I am not nearly as optimistic as the market seems to be about a V-shaped recovery. There was a lot of conflicting signals today. So we had, you know, Guy's been flagging that tensions with China on trade are really a risk, and they seem to cool somewhat. So, and the market rallied, I think, on that. But you had treasuries very strong, so yields much lower. That's not consistent with a V-shaped recovery. Then you have gold up big. That is, you know, inflationary. So a lot of different things going on. So a day like today, I'm paralyzed. I don't know what to do. I don't find any particular bargains there, and yet I don't want to sell what I own. So I'm just kind of hanging out. The VIX also is sort of in limbo around 30, 31. So I'd like to see it come in and buy some more protection. So like Dan, I'm skeptical that we'll have this V-shaped recovery. However, this Fed action was so extraordinary that, you know, I mean, they're just throwing trillions with a T, which is hard to even believe that we throw those numbers around casually now, trillions of dollars at the problem. So it doesn't make me want to be short the market.
Right, and that's something that didn't fit into
I'd never be short anyway. I'm long.
Right, that's something that didn't fit into our nice two-column chart there when it comes to a year ago versus today, and that is the Fed and its extraordinary actions, including basically a blanket guarantee of virtually every kind of debt out there, Tim, on top of a lot of stimulus coming out of Congress.
Right. So the Fed is the plutonium in the flux capacitor. I mean, they've absolutely taken us to an era where you've had this extraordinary thrust in the market, whether it's to another place in time or whether it's to a place where the market doesn't belong on fundamentals. You also have equity underweights everywhere. You have equity shorts in many places. And so I think this has a lot to do with where the market is, with rates at zero and the Fed basically making it clear that they will do whether they are doing has been enough for the equity market. We all know that the economy's in not great shakes. We all know that, I mean, the earnings after the bell today were largely horrendous, especially with companies that are looking into the second and the third quarters. But when you start to get some sense of the bottom is when markets are going to start to rally. So while I don't think we have to necessarily charge higher, I think you should take it as a victory that the markets have held on to most of those gains that nobody thought they were going to. And I think the markets actually behaved pretty well despite closing near the lows the last 2 or 3 days.
Dan.
Yeah, well, I'll just say this. I mean, I would say that the equal weight S&P 500 doesn't act well. It's down 20% on the year versus the S&P 500 that's down a little less than 11% on the year. We know why that is. It's the crowding in the MAGA trade, right? 20% of the S&P 500. Just look at the banks. Look at JP Morgan, how poorly it closed today, how poorly it trades in general, down 35% on the year. The bank stocks in the equal weight S&P 500 are telling you that the economy has not bottomed. You might see the unemployment number reach a top sometime very soon. But what's different this time than, let's say, the past financial crisis was that unemployment topped out basically 2 years after the stock market topped out. If you're telling me that unemployment in this crisis is going to basically top out within a month or two of the S&P 500 bottoming out of this crisis, I just don't believe it. It's not what's going to happen here. So to me, if you really want to focus on how the stock market's doing, look at the banks. They're telling you that this economy is going to be in a deeper and longer recession than most people think. And the equal weight S&P 500 is telling you that the rally is not as broad as most people think it is.